Canadian social and pension benefits. The Canadian government provides three main social benefits: Old Age Security, OAS, the Guaranteed Income Supplement, GIS, and the allowance. Old Age Security, OAS. OAS is a pension benefit for Canadians aged 65 and older that is based on residency, not employment history or income. To be eligible, you must have resided in Canada for at least 10 years. You can start receiving your OAS at age 65, or you can defer it until age 70 to receive a higher monthly amount. The benefit increases each year you delay it. The full OAS pension is for those who have lived in Canada for 40 years. If you have lived in Canada for 10 to 40 years, you will receive a proportional amount. For example, 20 years of residency would grant you half of the maximum pension. As of 2016, the maximum annual pension was about $7,000. OAS is a taxable income that you must report on your tax return. It is also subject to a clawback based on your individual income, not family income. In 2016, if your individual income exceeded $74,000, your OAS benefit was reduced by 15 cents for every dollar earned above that threshold. An individual earning around $118,000 would lose the entire OAS benefit. If you leave Canada, your OAS payments will stop if you are a non-resident for more than 183 days, about 6 months. However, the payments can be reinstated once you reestablish residency. A key exception is if you have lived in Canada for at least 20 years since the age of 18. In that case, you can continue to receive OAS payments even if you live outside the country. OAS benefits are indexed and adjusted quarterly to keep up with inflation. Guaranteed Income Supplement, GIS. The GIS provides additional financial support for lower-income individuals who receive OAS. It is not a taxable benefit. Eligibility for GIS depends on your family's income and marital status. For example, as a single individual, you might be eligible if you make less than $25,000, while a family income of $30,000 to $40,000 would likely disqualify you. Unlike OAS, you must be living in Canada to receive GIS payments, and they will stop if you leave the country. GIS is also subject to a clawback, typically at a rate of 50 cents for every dollar you earn above the income threshold, which was around $25,000 in the provided source. Allowance. The allowance is a non-taxable benefit for a low-income spouse who is between 60 and 64 years old, while their partner is receiving OAS. This benefit is designed as a form of supplemental financial aid and stops once the younger spouse turns 65 and becomes eligible for OAS on their own. Similar to GIS, you must be a resident of Canada to receive the allowance. Canada Pension Plan, CPP. The Canada Pension Plan, CPP, is a contributory plan that provides retirement, disability, and survivor benefits. Unlike OAS, CPP is not based on residency. You must contribute to the plan to receive benefits. Contributions are mandatory for all working Canadians aged 18 and older, including self-employed individuals. Contributions and eligibility. The contribution rate is 9.9% of your yearly pensionable earnings, split evenly between the employer and the employee, 4.95% each. Contributions are not required on the first $3,500 of annual income, known as the Yearly Basic Exemption, YBE. The Yearly Maximum Pensionable Earnings, YMPE, is the maximum income amount on which you must contribute, and this amount changes every year. In 2016, the YMPE was around $54,000. To qualify for a CPP pension, you must contribute for a minimum of 10 years. To receive the maximum benefit, you must have contributed for 40 years. CPP is fully taxable, but it is not subject to clawback or a residency test, so you can receive payments even if you leave the country. Receiving benefits. The standard age to begin receiving CPP is 65, but you can start as early as 60 or as late as 70. Starting early. For every month you start your pension before age 65, your benefit is reduced by 0.6%. Starting at age 60 would result in a 36% reduction. Starting late. For every month you delay your pension past age 65, your benefit increases by 0.7%. By delaying until age 70, you can increase your benefit by 42%. CPP benefits are indexed to inflation, but the starting amount is not. Survivor and child benefits. Spousal pension. If you die while receiving CPP, your spouse may be entitled to a survivor's pension. This is a spousal benefit equal to 60% of your pension amount. Child benefits. CPP also provides benefits for dependent children under age 18, or for children between 18 and 25 who are attending school full-time. Company-sponsored pension plans. There are different types of company-sponsored pension plans. They are generally either contributory, where both the employer and employee contribute, or non-contributory, where only the employer contributes. Defined Benefit Pension Plan, DBPP. A defined benefit pension plan is considered the gold standard of pension plans because it guarantees a specific income amount at retirement. This allows you to plan your retirement with certainty. Key features. Predictable income. The benefit amount is predetermined and guaranteed for life. Spousal benefit. A spousal benefit, often around 60% of the pension, is available if the plan member passes away. Inflation indexing. Many plans are indexed to inflation to protect purchasing power. Non-discriminatory. The plan must cover all employees, and the formula for calculating benefits is the same for everyone. Vesting. The money contributed to the plan becomes your property after a specific period, which cannot be longer than 2 years in Ontario. Once vested, the money is locked in and cannot be withdrawn as a lump sum. Taxation. All benefits received from the plan are fully taxable. Defined Contribution Pension Plan, DCPP. Also known as a money purchase plan, a defined contribution pension plan does not guarantee a specific retirement income. The final pension amount depends entirely on the total contributions made by you and your employer, as well as the investment returns over time. Key features. No guaranteed income. The benefit is not guaranteed, which makes retirement planning more difficult. Investment choice. The employee often has the option to decide how their money is invested. No waiting period. There is typically no waiting period to join the plan. No PA or PSPA. Unlike a defined benefit plan, there is no pension adjustment, PA, or past service pension adjustment, PSPA, associated with the DCPP. Taxation. All money received is fully taxable. Pooled Registered Pension Plan, PRPP. A newer type of pension plan, the PRPP is a federally regulated plan that is administered by each province. It shares many similarities with a defined contribution pension plan, as it functions like a deposit account and the final benefit is not predetermined. Key features. Non-mandatory contributions. While recommended, employer contributions are not mandatory. Immediate vesting. Contributions are vested immediately. Contribution limits. The maximum contribution limit is the same as an RRSP. Locked-in funds. The money in the PRPP is locked in and must be used for retirement purposes. Taxation. Any money withdrawn is fully taxable. Deferred Profit Sharing Plan, DPSP. A DPSP is a plan where the employer contributes a portion of the company's profits to an employee's plan. It is designed to be an incentive for specific employees who are crucial to the company's profitability, not a universal plan for all employees. Key features. Employer-driven. Only the employer can contribute to a DPSP. Employee contributions are not allowed. Vesting. Vesting cannot take longer than 2 years. If an employee leaves before the 2-year mark, they lose the employer's contributions. Not locked in. Unlike other pension plans, the money in a DPSP is not locked in. You can choose to take it as a lump sum, which is fully taxable, or transfer it to an RRSP or RRIF. Pension adjustment. DPSP contributions create a pension adjustment, which reduces the amount you can contribute to your personal RRSP. Registered Retirement Savings Plan, RRSP. An RRSP is a government-created savings plan designed to help Canadians save for retirement. Contribution rules. Limit. You can contribute up to 18% of your earned income from the previous year, to a maximum annual limit set by the government. Previous year's income. The calculation is always based on your earned income from the previous year, not the current year. Earned income. Only active income qualifies as earned income. Passive income like interest or dividends does not. Alimony payments reduce your earned income for this calculation. Deductions. Your RRSP contribution limit is reduced by any pension adjustments, PA, or past service pension adjustments, PSPA, from other pension plans. Overcontribution. You are allowed a one-time, lifetime overcontribution of $2,000 without penalty. Any overcontribution above this amount is penalized at a rate of 1% per month. Unused contributions. You don't lose your contribution room if you don't use it. It carries forward indefinitely and can be used in future years. Tax advantages. Deductibility. Contributions are tax deductible, which can lower your taxable income and result in a tax refund. Tax-sheltered growth. The money inside an RRSP grows tax-free. You do not pay taxes on investment income or capital gains while the money is in the plan. Withdrawals and maturity. Taxation. Any money withdrawn from an RRSP is fully taxable as income. Withholding tax. Withdrawals before age 71 may be subject to a withholding tax of 10%, 20%, or 30%, depending on the amount withdrawn. This is not the final tax, but a portion of the tax collected upfront. Maturity. You must convert your RRSP to a retirement income fund or an annuity by the end of the year you turn 71. Spousal RRSP. You can contribute to a spousal RRSP to split retirement income and potentially reduce your overall tax burden in retirement. You can continue to contribute to a younger spouse's RRSP even after you turn 71.